Welcome. I'm Catherine Magana here with Steve Wolf, Rachel Ivanovich, and Vince Stefano, where we're here to provide you some insights about the markets, investing, and taxes. And so here we are. Vince is back. He was actually at a reunion last weekend. And I'm not going to say, I'm not going to say how many years, but it's up to you if you want to share that.
I will share it. 50 years.
Wow.
Yes, I am old.
So you graduated high school when you were what, 25?
Yeah, just about. That's when I took the graduate record exam.
There you go.
All right, so here we are, and the markets are just, because the S&P and the NASDAQ hit just some record highs, and it was interesting as I was kind of looking at the markets this last week. There was the bifurcation trends, which is the S&P 500 weight index. Basically what it does is if you look at the equal weights against all the S&P 500, the year-to-date return would only be 3%. So it's interesting because obviously we've talked about in the past, there's certain sectors that are really carrying the market versus, it's up 14, 15% approximately this year-to-date. So I thought that was kind of interesting when you kind of pull out some of the big movers where the markets are really at.
It's really been that way for a while now. It was the Magnificent Seven, the top seven tech stocks, but it's pretty much down to maybe one or two now. But NVIDIA has just carried the entire weighting. So if you look underneath that, most of the stocks aren't doing nearly as well.
Yeah, I agree with that. And, when you look at the overall stock market bullishness, right now it's at the highest level since 2001. But what's also interesting, when you look under that number, the consumer sentiment has fallen for the last 3 months. So weaker retail sales we're seeing across the board. And the big question now is, will that increase any chance of an interest rate cut by the Fed? And we've been talking about that for I don't know how many months now.
They keep changing it. Now I'm hearing maybe there might be one cut, but we'll see. I don't know at this
Goldman
point.
Sachs came out. Some guy said, well, there may be two or there may be none. Now, that's a real hedge of a bet.
Yeah, which is why for the long-term investor, does it really matter? It's going to be up and down and up and down. But the real, and I say this almost every week, the real issue is what's the growth prospect for that particular company? What are the revenues? Are they profitable? Are they not? All these macro things are interesting, and they're good if you're a trader. If you're a trader and you're looking to, make what I'll call scalping some points, that's okay. But if you're the long-term investor, I'm not sure it matters. I heard this morning someone said, well, they think there's going to be a cut in September. Someone else said, well, not in September, but it'll be in December. There's going to be two next year. Nobody knows. Nobody knows. And does it really matter?
Well, the only place it does matter, and I'm going to kind of just digress a little bit from the stock market, and say that over the years, one of the biggest creators of wealth has always been home ownership. And what we're seeing now is that housing starts are falling, and they fell 5.5% May over May. Single-family home starts are down 5%. So what's happening is the housing market is now subject to major constraints, and that's all because, and it's relating to it's now resulting in an affordability issue. And because we've talked about this many times around this table, where young people and other folks cannot afford the houses, so they're moving into rental apartments. And rental increases are quite staggering over the last 12 to 18 months. And shelter inflation is now running about 5.5%, almost 6%. And that's been a real harbinger of what that inflation number
right. And of course, okay, so interest rates coming down a little bit will obviously help a little bit with the housing. But I'll tell you what, whether the interest rate is at 7%, 6%, or 5%, if the house that you're wanting to buy is $1 million, it's not going to matter. It would have to go back down to 3% and 2%. Yeah. At which time, if it did that, I think I would take out a mortgage again, because, you can make more money, I think, than 3 or 2%.
Yeah, you're right. And affordability is also because of regulations. And there's a lot of housing regulations where builders want to build, but, some of the cities they live in, there's 2 and 3 year waits for housing.
Well, and every economy, or how should I say this? There's an economic cycle happening all the time, whether it's up or down. It's always, that's a constant. All right. So yes, I mean, if you're needing, okay, here's another thing. If you're needing money, you should have that money set aside. All right. For the rest of what you have, it should be longer term, so that it doesn't affect us as much. Yes, the market can go down by a lot. It did that in, what was it, 2022? I think we started in October of 22 and probably lasted for about a year, and that was painful. But look what happened then in 23. Okay, and that's just the way our economy works. It's a capitalistic system, supply, demand.
So it's interesting. I looked at the Schwab MidYear update this last week, and a few things stood out to me. One, they talked about the time frame from October 2022 to end of May of 2024, and how large caps still dominate. Obviously, the S&P versus the Russell 2000. The S&P has done much better. But what really kind of was interesting to me was I didn't realize was for international stocks between October 2022 to end of May of 2024, that the EFA, or the international, actually beat the S&P a little bit. But longer term, year over year, the S&P has outperformed. But I think it's interesting when you look at different time frames. And yes, it's a really small area to look at, or a time frame. But I thought that was kind of interesting because I didn't realize that.
I also think, though, what's happening right now is that people are starting to come around to more stock picking than to index investing. So, yeah, the EFA did whatever, the S&P did whatever, but if you owned NVIDIA and you owned a few other stocks over the last year, you've done fantastically well, because it has done well. And again, that doesn't mean it will continue. As a matter of fact, I'm a little bit nervous, about where we are right now. So don't go out and buy it without talking to anybody. But you've got, in my opinion, some euphoria going on about anything that's AI. So I wouldn't be surprised to see a pullback on all these things.
And then one other thing that stood out was on the fixed income, which we've talked about. Obviously, the short term, the rates have been high, but they said to go out a little further on duration and barbell. And so those are definitely some things if you are looking to diversify. Once again, what's your mix of investments? And similar to what Steve said, you have some money set aside for your emergencies or cash flow needs, and then the rest should be invested.
Right. And how aggressive you want to be, or how long term you are, obviously one is a factor is your age. If I'm 30 years old, for me, I'm going to be very aggressive. I have a lot of time to make up for a loss. If I'm 80 years old, not nearly as aggressive, okay, because your days are limited. It could be a year, it could be 10 or 20 years, but that's not 50 or 60 years. That's a big difference. So the fact that, these technology stocks are doing well, it probably will do well for a while, or I'm guessing it will, at least, in our lifetime. That's what's happening. Technology is changing everything. So if you can figure out those companies that are, I guess, the ones that will take the biggest advantage of it, hey, you can make a lot of money versus investing in the S&P index. Not that there's anything wrong with that. Who said that? Not that there's anything wrong with investing in the S&P, because over the long haul, that's done well. But I think right now there are more people who are starting to say, maybe I should pick individual stocks. And it's for what you said before. The weighted, the non-weighted, the equal-weighted S&P index is up very little, whereas the weighted index is up a lot because a few stocks have done well.
Well, I think the big question is, do you have a tax strategy no matter your age?
And of course you would say that.
I'm an enrolled agent. Of course I'm thinking about the taxes, because even investors who spend a lot of time thinking about their portfolio and they think about performance, maybe they're not thinking about tax efficiency. And there's something that I think is really interesting to think about, which is using tax-aware asset location. And that what that basically means is, I know, that's clever, right? Yes. So what that means is, so for instance, if you have qualified plans, IRAs, 401ks, et cetera, are you putting investments such as dividend-paying stocks and corporate fixed income, those that are generating income, into those qualified plans so that you're deferring the taxes on that? So you really want to think about, what's invested in what sort of account, because if you, for instance, if you've got municipal bonds, which are federal tax-free and often state tax-free, if you're putting those in an IRA, sometimes you're not necessarily being tax efficient, versus if you put that in a taxable account, you have the tax break there.
Yeah, it's rare that municipal bonds will outperform, or I should say, would have a higher interest rate than corporate bonds, but sometimes that does happen.
Yes.
But for the most part, you don't want something that's already kind of tax-free or tax-deferred
in a tax-free account. Exactly. And I think a lot of people, they really don't even think about that. So I think it's really important to, look at, what you have in your different various accounts. And as you were talking about homes and potentially, I'm thinking, people are moving. I have a lot of clients who are putting their homes on the market and moving right now. But are you actually thinking about the tax consequences of that before you actually do it? And if you're moving to a different state, what the tax ramifications of that other state are?
So we were talking just a minute ago about longevity and clients living longer. And it's interesting, this last week we actually had 2 clients reach out to us. One, her mother just passed away at age 100, and another one, the mother passed away at 106. So people are living longer. I mean, this is definitely something you want to plan for. And obviously, who knows how long we're going to live, but with healthier lifestyles and cost of living, I mean, everything, all this stuff gets factored in. But it's something that we do when we invest. We also have to factor in that we're going to, we obviously need this money to last.
And of course, going back to inflation, which we've talked about a lot, that's the reason that inflation is so insidious. You're taking a pay cut every time things get more expensive, which is really why right now, although the economy is okay, but people don't feel it because they are paying a lot of money for the things that they use a lot. The food is very expensive.
Rents, as we said, rents are
expensive.
In fact, Greg has been talking about that around this table now for 3 months.
Mm-hmm.
He brings this chart out.
And where we are in the San Diego area, it's more expensive than most places, but it's still expensive relative to wherever you live. So anyway, it's probably a wrap for this week. And we'll talk to you guys again next week and give you some words of wisdom. Thanks a lot. Bye-bye.
Bye.
Bye.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.